Housing prices in America just broke a new record high. We're now at the point where you need to earn $106,500 to afford a typical home in America compared to $59,000 just 4 years ago. But this is where things get really interesting. Redfin just published a study saying that the typical home is now selling for less than asking price for the first time since before the pandemic. And the reason why it's so important for you to understand this now is because of, well, inflation. The Federal Reserve Bank says that because inflation is cooling down, they're on target to start cutting interest rates before the end of 2024, which naturally has all the realtors, builders, and bankers excited saying, bring on the cheap mortgages. Unfortunately though, this is not a battle you can win without any pain. And the real question here is who the Fed wants to pay this price. Is it going to be the home buyers, the home sellers, or the real estate professionals? Let me explain. See, right now we're in what I'm going to refer to as a frozen seller's market. I call it frozen because we have the lowest number of real estate sales happening ever, but despite the limited real estate transactions, it's still a seller's market because there's so few homes available for sale. And despite the higher prices and the higher mortgage rates, you still have buyers that are willing to pay the price. We talked about this in market briefs last week, but the high home prices and the high mortgage rates that we're seeing right now are benefiting home sellers, but they're hurting the home buyers and they're hurting the real estate professionals. They're benefiting sellers because if you own a home, well, you can still sell your home for top dollar. Home prices are selling for the highest prices ever, but they're hurting home buyers because if you want to go out and buy a home, we also have the least affordable housing market really ever, and it's hurting real estate professionals because bankers and realtors get paid when a transaction happens, and we're seeing some of the lowest levels of real estate transactions really ever. This is where I want us to start thinking a little bit ahead into the future, because if the economy stays kind of like what it is today, and I know that is a big if, but let's assume that the economy stays similar to what it is today, and then we see the Federal Reserve Bank start cutting interest rates because, well, a lot of people have been putting pressure on the Federal Reserve Bank to start cutting interest rates. If mortgage rates go down, what would that do to home prices? What would that do to the housing market? Well, if home prices go down, we know that home buyers would probably like it, at the beginning at least, because now instead of paying a 7% mortgage, you might be able to get a 4% mortgage, hypothetically. And so a home buyer would say, oh, this is great. I can finally enter the housing market again and get a more affordable mortgage. But then what ends up happening is, well, if you have a lot of buyers entering the home market, you would see home prices also rise, because now you have a lot of buyers competing for those same homes. And so if home prices start to rise, that also starts to benefit sellers, and that also is benefiting the realtors and the bankers because now more transactions are happening, which ultimately then would come back to haunt the home buyers, because if lower mortgage rates attract more buyers and that pushes home prices higher, that means you're going to need more dollars to go out and buy that same home. I mean, we saw what the low mortgage rates did to the housing market between 2020 and 2023. Home prices shot up by 40 to 50% around the country, which is why it's so much more expensive to buy a home today versus just a few years ago. Likewise, if we started to see a shift in the economy and now home prices started to fall, well, that's also going to hurt some people. It might be beneficial to you if you want to buy a home because now you need less dollars to go out to purchase a home as a buyer, but that's not good news if you are a seller, because if you're a seller and home prices are falling, you don't have as much equity as you thought. You might actually have to sell your home for a loss. And this could cause more foreclosures to happen if you're struggling financially, you can't make your housing payments, and now you don't have any equity and you can't get out of the home. This is where home prices falling would benefit some people, like buyers, but it would hurt sellers, and it could benefit or hurt real estate professionals depending on what's happening with mortgage rates, because if we have more and more transactions happening, well, that will benefit the realtors. I mean, right now, home prices are high, so the commission checks are high, but there's not that many commission checks coming in. So you got to remember, the realtors and bankers, they're paid based off of volume. The more transactions that happen, the more checks that are being cleared, and generally the more money that you're making. Sure, higher home prices lead to bigger commission checks, but if you're getting one check every 4 months, that's probably not going to sustain you. This is why I say it's very important for you to pay attention to what's happening with the Federal Reserve Bank and our economy, because this can give you some indication as to what's happening with home prices and mortgage rates, because this can dictate what's going to happen in the housing market. Now, of course, we keep you updated in Market Briefs. Market Briefs is my free financial newsletter that my team at Briefs Media publishes 6 days a week. It's a free breakdown of what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description. below. But this is where now I want to talk about what Redfin is saying is happening in the housing market right now. According to a new report published by Redfin in the end of June, they are saying that now we're finally seeing some softening in the housing market for the first time since before the pandemic. Here's what the report said. Buyers are shying away due to sky-high housing costs, and agents say that both buyers and sellers should be realistic about prices in today's market. If you remember what I said just a couple of minutes ago, that we are in a frozen seller's market, well, we're starting to see a shift away from a super strong seller's market. We're still in a seller's market, but what we're seeing is less and less buyers want to participate in this market, which means the markets are starting to balance out. There's not that many sellers out there, but we're also seeing a falling number of buyers that want to play this game because buyers are essentially saying we have high home prices, high mortgage rates. I can't keep affording these higher and higher prices as home prices keep breaking new record highs. And this is where now Redfin is telling real estate agents to be a little bit more realistic about home prices for both buyers and sellers. What does that mean? Let me show you. Some buyers think that they can get a deal because they're hearing that the housing market is cool. And some sellers think that every home will sell for top dollar no matter the condition. In other words, buyers think that this is their opportunity to get a steal, and sellers think that this is their opportunity to get top dollar. Redfin's saying no to both of them. In reality, everything depends on the house and the location. The hottest properties in the area are either move-in ready or complete fixer-uppers. The homes in between, those that are pretty nice but not updated, are sitting on the market the longest. If you've been kind of following the housing market at all over the last number of years, you can see that we're starting to see a shift in tone in the way now people are talking about the housing market, because before it was if you own a home, you'll be able to sell it for top dollar. You'll be able to sell it for over asking price. Now, it's if you have a fixer-upper, those discount properties, that you'll get a lot of attraction for that. And if you have one of the top tier homes in a good area and it's already remodeled, you're going to get a lot of attraction for that. But now we're starting to see at least some homes, the middle ground homes that are nice but not fully updated, that they're sitting on the markets and you might have some more negotiating room. Before, there was no negotiating room on anything. Now we're starting to see some softness there because we're starting to see some negotiating room, which is why we're starting to see some home prices sell for below asking price. Again, not a drastic change, but it's a big shift from where we were before because it was a super strong seller's market. Now we're starting to see it balance out a little bit more. The reason why this matters is because, of course, we're seeing a lot of changes happen. Obviously, we've been seeing cooling in the economy. We've been seeing a cooling in spending. We've been seeing debt levels hit record highs. But at the same time, we're also now thinking about what's going to happen with interest rates in the future because the Federal Reserve Bank has said time and time again that inflation is now cooling. We're not at their target inflation number yet, but we're heading towards that direction. Are we going to see interest rate cuts in 2024? Well, the Federal Reserve Bank says probably. Now, is that guaranteed? No, of course not. Nobody has a crystal ball to predict what's going to happen next month. But the Federal Reserve Bank says they are anticipating at least one interest rate cut before the end of the year. I'm not saying that's the right thing to do. I'm just telling you what the Federal Reserve Bank says. So if now we start to see interest rates get cut, hypothetically, that could make housing a little bit more affordable in the sense that you could get a little bit more of an affordable mortgage, which could drive more buyers into this market, which could strengthen this housing market even more with more buyers, which could shift the dynamic of the market. This is why I want you to pay attention to what's happening, because at the end of the day, a home price is not determined by what you think it's worth what somebody else is willing to pay. And so if you think your home is worth $500,000, but nobody's willing to pay you more than $450,000, well, that home is worth $450,000. But if you own a home worth $500,000 that you think is worth $500,000, but somebody's willing to pay you $600,000, well, now that home is worth $600,000. And between 2020 and 2022, people were willing to pay way over asking price because the debt was cheap. So people didn't care about what the cost of the home was. All they cared about was the monthly payment. And because the monthly payment was cheaper due to the lower mortgage rates, people were willing to pay way over asking price because they weren't caring about the number of dollars. They were just looking at the monthly mortgage payments. Now it's a little bit different. As mortgage rates have come up, people care about the cost of the home. They're also caring about the mortgage payments because now it's a double whammy. You have high mortgage payments and high home prices. But if mortgage rates start to come down, that can start to flip things a little bit more. People maybe don't care as much about the home price. I'm sure they still will because home prices have gone up so much, but maybe not as much, which again could shift the dynamic of the housing market. But of course, only time will tell. This is where I want you to be a financially educated person. And if you're thinking about buying a home, well, I want you to make sure that you can afford the home. That means afford the down payment, afford the monthly payment, and afford the moving costs. Because the last thing that I want you to do is go and start to chase the housing market or freak out and not buy a home because of what you think is happening in the economy. But rather, I want you to buy a home when you can afford it. That means you can afford your monthly payments, you can afford the down payment, but you still have money to eat, you still have money to invest, and you still have money to save. That way you continue to build your wealth outside of your home, because the reality is your home is not what's going to make you wealthy. Your other investments, your rental properties, your stock market investments, your business investments, those are the things that are going to make you wealthy, not the home that you live in. When it comes to you buying a home, treat your home like an expense if you really want to build wealth, and use your other investments as your assets, and make sure if you go out and buy a home that you don't do it at the expense of being able to actually build some real wealth. In the early 1930s, we had the Great Depression, we had the market crash. But then in the 1970s, we had another market crash because of the high inflation and the slowing economy. This was an era of stagflation that really hurt the economy. 2001, we had the dot-com bubble burst. You can see the market crash again. 2008, we had the real estate meltdown. But after each time, you'll see that the stock market recovered.